course, we are paying so much attention to the global banking sector, and we want to take a look at who has the money and how corporations that have it can be encouraged to spend it. Stephen Charest is with us now. He is the Chief Market Strategist at Divine Capital Markets. Steve, thanks for coming on the Inside Track. Operation Twist, you were laughing, actually, during Michael McKee's hit. Yeah, you're not allowed to laugh right here on the Inside Track. So what does this mean for banks? What does this mean about money flow, who has it, and where it needs to go?
Yeah, well, you know, the Fed's had a hard time historically influencing long-term rates. The market very quickly discounts those actions. Our concern has been, if you look at what segment of the economy has the money, the government's out, the consumer is out. The corporations have done actually a rather good job at restocking, refinancing, and building up cash balances, whether you're a business
thanks in part to the government
in
some ways and the taxpayer.
You know, yes and no. I mean, they deleveraged because of low rates, but we had low rates already, and they were able to cut costs, unfortunately, by laying off a lot. But they did build up cash reserves. The challenge here is getting them past that fear factor of spending the money, investing the money, and ultimately that's where employment's going to come from.
Steve, what I think many people find difficult to understand is what is holding companies back. There is a lot of cash. Okay, we know that some of the cash is overseas, and maybe the inhibitor to bringing some of that money into the United States is some change in tax policy, and perhaps that'll be forthcoming. But how is it possible that these companies are comfortable having cash on their balance sheets, earning effectively zero, rather than investing it in something?
Right.
Surely something is going to return more than zero.
Yeah, better than zero is optimal. Right now, corporate managers have a couple of concerns. Will I get taxed more, or what's the likelihood of getting taxed more? How much more will I get taxed? How many taxes am I facing? I mean, there's the risk of health care, employment, payroll, any number of, a barrage of taxes and health care costs face them. So they've been hesitant to do it, and the repatriation of the funds is also a tax issue.
Let's play what if. What if President Obama says later this week that companies who hire people who have been on unemployment for, say, more than a year will receive a tax benefit? Do you think that would change things for the better significantly?
I think that would be a step towards having an economic policy. If you incentivize a corporation to invest the money in something, capital equipment, expand their business, what have you, then you've got employment and supply. Nobody hires unemployed people simply to hire unemployed people. They just did the opposite in order to make sure that their profit margins and their growth is going to be consistent. So right now, they're playing it safe by doing buybacks.
Steve, to what degree is the market trading on this, or at least trading in anticipation of something? Let's say the federal government came out with some broad list of tax incentives to encourage businesses to start to invest, to encourage businesses to bring capital back from overseas. How might the market trade, both in terms of equities and in terms of bonds, where we've seen spreads in both investment grade and high yield back up by about 50% over the last several weeks?
Yeah, I think that the stock market could do better. This same scenario faced President Kennedy, where he did an investment tax credit after ignoring the advice of, I think, Samuelson's team. And right now, I think the market is discounting what degree of slower growth or recession discounting could they possibly get away with. I think that's the process right now. But if we did have some kind of economic policy going forward, I think the market would react rather positively. As far as the bond market, I think our 30-year decline in rates has ended, and we're most likely to see rates go up regardless of policy short term.
And that's because of the inflation risk built into a further round of quantitative easing, or something else?
Yeah, there's a stunning amount of liquidity that's been flooded into the system, and absent the transmission between Fed policy and the real economy, being the banking system, absent that, the money's gone into speculation worldwide.
Steve, we thank you for joining us on the Inside Track. Hope you come back. Steve Charest joining us there. He is Chief Market Strategist at Divine Capital Markets.